This is the method regulators call the hardest to catch, because it hides inside something that looks exactly like ordinary international trade. You ship a container of furniture and invoice it for way more than it's worth. The importer pays the inflated invoice. The difference just crossed a border, disguised as a totally normal trade payment. Customs agencies are built to catch smuggling, not to fact-check whether a container of furniture is priced fairly. That gap is the entire method. One weirdly priced invoice doesn't prove anything. But a company doing it systematically, hundreds of times, over years? That statistical pattern is exactly what finally gets a customs fraud unit's attention. By this level you've stopped mimicking legitimate business, and started exploiting a financial system still catching up to the technology it now has to police. Enter the mixer, pool your crypto with everyone else's, and get back a clean amount with no visible link to where it started. At least, that's the promise. Here's the irony. The blockchain is both the tool that enables this and the reason it eventually fails. Every transaction is permanently, publicly recorded forever. Forensic tools can sometimes trace funds through a mixer just by analyzing timing and clustering patterns across the whole pool, even when no single transaction gives it away. Some mixing services have been seized outright, and their own transaction logs retroactively unmixed years of activity in a single stroke. The anonymity was only ever temporary. Beyond mixers, you exploit the gap between exchanges, move funds from one with strict verification to one with almost none, then cash out through a door the destination exchange never really watches. At the biggest scale, individual transactions barely matter, because the laundering happens inside the relationships banks maintain with each other to move money globally in the first place. A bank willing to look the other way, or just too undertrained to catch a sophisticated pattern, can process billions in suspicious transactions for years before anyone notices. These cases usually unravel because of a whistleblower, or a regulator on a routine review who notices the volume just doesn't match the client's actual business. It's rarely one executive knowingly signing off on crime. More often it's an under-resourced compliance team drowning in thousands of daily alerts, and a bonus structure that rewards speed over scrutiny. From the inside, the biggest laundering scandals in banking history look less like a conspiracy, and more like a slow institutional failure to ask one obvious question at any of the dozens of points someone could have. Behind almost every major laundering prosecution, there's a person, not just a paper trail. An accountant who kept records they weren't supposed to. An employee passed over for a promotion who decides compliance needs to see something. A shell company's registered agent, finally talking after years of quiet unease. Some jurisdictions now offer real financial rewards for insiders who report these schemes, because internal cooperation cracks open networks external investigation alone often can't reach. Someone who actually sat in a meeting where an executive decided not to ask an obvious question holds information that years of subpoenas might never fully reconstruct from the outside. Structuring, shell companies, real estate, offshore trusts, trade invoicing, crypto mixing, correspondent banking, every one of these can survive years of external forensic scrutiny. Almost none of them survive one motivated insider deciding they're done staying quiet. Every level of this, from a duffel bag of cash to a correspondent banking relationship moving billions, depends on the same vulnerability. Money has to explain itself eventually, to someone, somewhere. And every explanation outlives the transaction. Financial intelligence units, FinCEN in the US, and their counterparts worldwide, exist to pull suspicious activity reports and cross-border wire data into patterns no single bank or country could ever see alone. One invoice looks unremarkable alone. That same invoice cross-referenced against 40 others, flagged by different banks in different countries over years, starts to reveal a structure that was always there. Most major laundering prosecutions take years, because every layer, every shell company, every jurisdiction is specifically designed to multiply the labor of anyone trying to trace it backward. It doesn't fail because investigators lack the tools. It fails when tracing it costs more time than a case ever gets allocated, before political pressure, a deadline, or simple attrition ends at first. If this changed how you think about where dirty money actually goes, that's exactly why this channel exists. Tell me in the comments which level surprised you most, and if you want the next one broken down the same way, hit subscribe so you don't miss it.